Hello and good evening, everybody. Welcome to tonight's session on SGX Tuesday. We basically have a topic on what do you do when prices fall or when prices go now into a downtrend. Before I start, if you can hear me, can you just type in yes on the comment section? Thank you. Hi, Mr. Marvin, Sam, for joining us tonight. Okay, thank you, Sam. All right, looks like we're all set to go. If you guys have any questions at all, you can just post it on the comment section. Thank you, Chua. Thank you, Zina. Okay, so basically today is a topic on what you can do when prices fall, because we all know that there are opportunities when prices fall, but it's always easier said than being done, because when prices fall, many people are fearful, right? And basically Warren Buffett just put it in a very simple context in his investing principle, which is be fearful when everyone is greedy and be greedy when everyone is fearful. So this is a little bit, it's always easier said than being done, right? Because it always makes sense when prices go up and people start to buy, because we are looking at prices going up. But when prices are falling, although it creates an opportunity, but we all just afraid that price is going to come down even more. So how do we know, right? When the price starts to fall, whether there is opportunity, whether the risk is low to actually buy when prices are falling. What we do not want to do is to catch a falling knife, right? So here we are basically going to look at very simple tools that you can immediately apply. By after today's session, you should know how to look for these opportunities, and it's all based on price charts or technical analysis. All right. So I'm going to give you a context first on how we derive the methodology on how you can identify these opportunities, and we do have a tool for you to use to identify these opportunities easily as well, right? Like for example, if you do not know what stocks that are actually falling and fall to a level where there is opportunity, then we have actually created a special tool for you guys, and it's free of charge. All right, so I'll basically let you know later as we go on. All right. Now, this is the software that you can use on the website. It's sgx.equitiestracker.com. Okay, this is where the tools I'll be sharing with you guys later. But we basically need to learn how to use it first, right? Or basically the method behind this. So therefore, I have to explain this. And if you have came to the previous webinar where I talked about how do you identify uptrend support opportunities, or basically when price starts to pull back in an uptrend, right? So this is the second part of it. Okay. The first part is how do you identify opportunities in an uptrend. But in this part, in this webinar, we're going to talk about how do you identify opportunities in a downtrend. All right. So two separate trends altogether. So if you know how to find these opportunities using charts, then that's fantastic. All right. So this is one of the ways you can identify these opportunities. All right. So sgx.equitiestracker.com, you can check it out even right now. This is just the first phase. We have a second phase coming, which is going to give you an in-depth analysis on the REITs market in Singapore, because the REITs market in Singapore is pretty much vibrant. Okay, it's one of the because the properties mostly are outside of Singapore, international properties. Instead of Malaysian market REITs, most of the properties are local properties. So you may want to check out later when we go into phase 2. Hopefully in the next few weeks, you should be able to have that tool up there on sgx.equitiestracker.com. All right, but for now, we also have these tools which we can use. And again, that's to identify the uptrend support opportunities, which I explained in the previous webinar, which is last month. And today we're going to look at downtrend opportunities. All right. So trend, I'm just going to go through this very briefly because we already talked about this in the previous webinar. Okay, but this is just to again to give you the context of how we actually get this idea or this method, right, to identify opportunities in the downtrend. So we all know a bullish trend is when prices are rising. Okay, that's the most easiest indication, okay, on a chart that you on the price chart. When you see prices are going up, it's an uptrend. When you see prices are going down, in a downtrend. It is easy because what we are seeing are historical prices. These are prices that has already been done or traded, right? What is important is actually when you're making decisions right now. Okay, this is your decision-making point, okay, where the charts are not plotted yet. All right. So we look again. Technical analysis is all about identifying the past trends or the past movement on prices and try to determine what could possibly be the future price movements. Okay. And it's also to understand market behavior. Okay. So by definition, when we have the highs getting higher and the lows are getting higher, we have an uptrend. In a bearish trend, prices are going down. So we have the highs getting lower, the lows are also going lower. All right. This is the basic identification. In a short while, I'll show you how you can use the moving average to identify trend. Okay. If the highs and lows move into opposite direction, right? That means there's no clear direction between the highs and lows. Then we have a sideways trend or a directionless market. Okay, there's no direction. Okay. Now we're going to take a look at moving average because this is a most simpler way to identify a trend. Okay, a moving average is basically a calculation of average price over a period of time. For example, if you calculate a 5-day average, then you add up all the 5 days of data and you divide by 5. If you're looking for a 100-day average, then you add up all the 100 days of data and you divide by 100. Okay, why do we look for average price? Now, prices are volatile, right? For example, if the price is trading at 120, it doesn't mean that it's going to trade at 120 all the time. It fluctuates, right? It goes 120, it can be 122 tomorrow, then the next day it can go down to 118. It fluctuates, right? So in order to smooth out this volatility or this fluctuation in price, we use the average price, right? The average price is to smooth out all the data that we are sampling so that we get an average, okay? It's called a moving average because right now, for example, if you are calculating a 5-day moving average, you add up all the 5 days of data, okay, let's say from day 1 until day 5, and then you divide by 5 and you get the average price, okay? But tomorrow a new data will come in, right? Because tomorrow there's a new price, so you take tomorrow's price and the previous 4 days price, a total of 5 days again, and you calculate a new average. So every day you have a new average because every day you have new data coming into the calculation. So that's why it's called a moving average. Okay. Now, why is a moving average important? Okay, this is basically a sample of a moving average calculation if you want to look at the formula, right? Now, why is moving average important? Okay. So we all know average price, right? So if the market is trading prices above the average, what does it mean? It simply means that they are confident. Most of the time, the market is thinking that the price can even go higher, and therefore they are willing to trade at higher prices. Okay, so the willingness of these traders to trade at higher prices shows that the market sentiment is bullish. Okay, their opinion is that the price can go even higher, and that's the reason why they are willing to buy at higher prices. Okay. If the prices are traded below average, it simply means that they are not confident enough that the price can go up higher. In fact, they are thinking that the price can even go lower, and therefore they start to trade at lower prices, whether they are buyers or sellers, right? If they are transacted below the average price, it simply means that the sentiment is bearish, because trends is all about sentiment, right? Whether the opinions toward the market is bullish, whether they're expecting price to go up, or it's bearish when the price are expected to go down. Okay. Now, this is a rule of thumb when we use to identify average, because when we calculate average, there are short-term average, medium-term, long-term, super bull run. I mean, there are many different cycles that you can use to identify an average. Okay, but here we are looking at a very simple way of identifying the average. If you use any moving average that's below 30 days, it's considered as short-term. You're trying to identify very short-term. 30 days is like a 1 month average, right? So you're looking at a monthly trend. Okay, if you want to go even shorter, like a 5-day average is like a weekly movement, right? A weekly average. So you can basically change the moving average to identify which trend you want to catch, right? Are you trying to identify the intraday trend, for example? Are you trying to identify the weekly trend? Are you trying to identify the monthly trend or the yearly trend or even the quarterly trends and so on? All right. So if you're looking at short term, 30-day moving average and below, If you're looking at medium term, then that's 30 days and above, up to 90 days. And anything that's above 90 days or 91 days, that's long term. Okay. So the question is always I get is, which moving average do I use? Right? Should I use short term? Should I use long term? Okay. Yeah, that depends on your objective, right? If you are looking for long-term movement, long-term trends, then you look at long-term moving averages. If you're looking at short-term, then you use short-term ones. All right. So I'll give you a few examples, but mostly the examples I'm going to give you is based on a short-term trend. All right. So the use of moving average is basically to identify trend. That's the main purpose, right? If the price is above the moving average, like I mentioned earlier, and it continues to stay above the moving average, it simply means that the price is in a bullish trend. Okay, the market sentiment is bullish. If the price stays below the moving average and continue to stay below the average, then we have a bearish trend. This is where when we have a sideways trend, the price does not stay above or below the moving average. It keeps on cutting the moving average. Okay. At one point of time, it can be above, saying that it's bullish, and then maybe after a few days or a few weeks later, the price comes down back again, go below the moving average. A few days later, it goes up again. All right. So if it cuts the moving average very frequently, that means there is no direction. Okay. So we have a sideways trend. So this is an example. If you apply a moving average on a chart, and the moving average is, this is like a mother of all indicators. You can find this in any charting software that you use. In fact, if you go to sgx.equitystracker.com, right, you are also able to use the charting tool. Okay. It's all available once again for free. Okay. So if you look at this movement here, there's a moving average here. I believe this is a 90-day moving average. If the price is trading, this is the black line here. You see that's the price. If it's trading below the average moving average, then it's a downtrend. But once it starts to go above the moving average and stay above the moving average, then that's an uptrend. Yeah, and like I mentioned to you earlier, it's always easy to identify the trend because this is historical, right? You don't even need to apply the moving average. You can see whether right now is the price trend bullish or bearish. But it is what you do with the trend is going to be significant or important. All right. So you really identify now whether the trend is up or down, but where is your entry? Where's your exits? Okay. So we're going to cover that in a short while. Okay. So if you apply different moving average, it gives you different indication of a trend. For example, here the red line that you see here on the chart, that's a 90-day moving average, which is long term. Okay, so if you look at this whole period over here, the moving average has been declining, and the price is trading below the moving average most of the time. So in the long term, this whole chart that you see here, the price is moving into a downtrend. But if I were to apply a 10-day moving average, you can see the moving average is much closer to the price because it's short term. Therefore, if the moving average is declining and the price is staying below the moving average, we have a short-term downtrend. All right. But in that long-term downtrend, remember this whole trend here is down in the long term. Okay. But in the long-term downtrend, we can also have short-term uptrends, right? Because the price is above the moving average and the moving average is going up. Then you can have downtrend again, and you can have uptrend again, and you can have a downtrend again. So short-term movements, you have more short-term movements if you are looking at the short-term trends, right? If you're looking at a longer-term trend, of course, then you're looking at a bigger picture. Okay, so depending on what trend are you trying to identify, right? If you want to catch all the small movements on a 10-day moving average or very short-term trends to buy and sell in the short-term movement, then you use a shorter-term moving average. But if you do not want to trade in the short term, you just want to wait for a really long-term trend starting to develop, which can take some time, then you look at a longer-term moving average. All right. Now, the other part of moving average, the other usage of moving average is the moving average should act as support and resistance. All right. Now, what is support level? We all know that support means support, right? That when the price comes down to this level, it cannot go lower. All right. So it forms a support. It forms a floor or a base. Okay. So that's support. But what support really means is that when the price falls to that level, it is a level where it attracts most buyers. All right. So you're going to look at the emotions or market behavior. You're going to ask back these questions. How does it affect the buyers and sellers? Okay. So when prices fall and if there are a lot of buyers are attracted and start to buy, then of course price stop falling. right? Same thing with resistance. When the price goes certain level at a high, right, then it start to attract a lot of sellers. And when these sellers start to take action to sell, the price is being resisted from going higher. So that's what it's all about, right? Support and resistance. So support level, once again, it's a level where it attracts most buyers, and that's the reason why price can't go lower, right? And resistance levels are levels when the price attracts a lot of sellers, okay? So how do we use moving average as support or resistance? Remember, moving average is an average price. Okay? For the market, probably the safest price to trade is at the average. Okay, I'll give you an example, right? I know some of you probably by now, after we're having MCO for almost 2 years, we are all very familiar with online shopping, isn't it? Okay. And for example, if you want to buy a handphone that is worth 2,000, I do not know how much it is right now in the market. So what do I do first on, let's say, Shopee or Lazada? Okay, what would you do first? You can search for the product, isn't it? For example, you want to buy, let's say, an iPhone. Okay, iPhone does not cost 2,000, maybe about 6,000, right? So you can search for iPhone. Let's say iPhone, I don't know what's the number right now, maybe 12. Okay, so let's say you search for iPhone 12, and you search and you look for the prices in it, because every seller sell at different prices. Okay, and then you find out that, once you have found out all the prices, you see that the average price is probably around, let's say, 6,000 ringgit lah. So if the seller is selling at 6,005, you know that he's selling at a high price. All right. If the seller is selling at 5,000 ringgit, then you know that he's selling at lower prices. Okay, but probably that lower prices at 5,000 ringgit is only limited, right? It's very difficult to get. Yeah. And if I can't get at 5,000 ringgit, I know that I can buy somewhere around 6,000 ringgit, because 6,000 ringgit is the average price. I will not want to buy at higher price. I will not, and if I'm a seller also, I would not want to sell at 6,005, right? Because if I'm going to sell at 6,005, when the average price in, let's say, the Shopee or Lazada for iPhone 6 or iPhone 12 is 6,000 ringgit, if I'm going to sell at higher price, I cannot sell at higher prices. So nobody's going to buy from me, right? But if I sell it near 6,000 ringgit, then I can sell, because there's a demand there. Okay, everybody look. So the average price is important, right? So when it comes to price movements as well, the average price is important. So with that, remember, the average price is like a magnet, right? It attracts whether buyers or sellers, because that's the average price where the buyer or seller can comfortably buy or sell. Okay, so that's moving average. So we use moving average not just to identify trend, but to also identify support and resistance. Okay, so let's take a look at example, right? We have this moving average over here. This is a 90-day moving average on this particular counter. It doesn't matter what counter you put in, right? If you put a moving average, now how do you know you apply a good moving average? Is when the moving average acts as support and resistance as much as possible. All right, because a moving average is a universal indicator, right? I do not know what parameter to put. I do not know how many days of moving average I need to calculate. 10 days, 20 days, 30 days, 40 days, right? So we have to adjust the moving average according to that particular counter. And we can't use just one moving average across all counters, because every counter behave differently. They have different kind of players, they have different kind of volume, different kind of volatility, and so on. So in order to apply a good moving average, you need to, this is just trial and error, right? You put in a 10-day moving average, for example, and you see that the 10-day moving average is easily being whipsawed, or the price can just cut above and below the moving average very easily. Okay, if you can cut it easily, it simply means that the moving average was not able to provide the support or resistance that you're looking for. Okay, like in this example, when I put in the moving average, the 90-day moving average over here, in a downtrend, okay, remember a downtrend is when the prices are trading below the moving average, right? In a downtrend here, the moment the price rebounds back to the moving average, okay, it can't go further higher. It can't go up higher. Okay, the price starts to pull back, and that forms a resistance. So you have A here as resistance in a downtrend, and then the selling pressure comes in again. It goes to B, and then once again it goes to A. All right, it acts as resistance. The moving average acts as resistance again, and the price starts to go down again, and then it starts to go to A once again. It becomes resistance, and then the price comes down again. Okay, But the moment the price breaks above that moving average, you can see that a new trend is being formed. So it's okay for the moving average to cut above the moving average, like in this case. But after cutting or breaking that moving average, it should form a new trend. Okay, then you know that you have applied a correct moving average. Okay, so why do we have resistance at A? Remember, in a downtrend, most of the market sentiment or the opinions of market is bearish. They are not so optimistic of the price. All right. And therefore, if the price starts to go up, because when the price is low, for example, when it goes to B, it attracts buyers because it's low, it's cheap, right? So there definitely buyers will start to come in. Okay. But as the price starts to increase and go back to A, what's going to happen here is the sellers will start to take advantage to sell. Remember, I give you the example of on an analogy of Shopee or Lazada again, right? If the sellers sell above average, okay, if they sell the price above the moving average, it's going to be quite difficult for them to sell at that price simply because they may not be able to sell it. It's too high. Okay, so the safest price for them to sell would be the average price, which is near A on the moving average. Okay, so when they start to sell here, then the price starts to come down again. Okay, and when it gets really cheap and the price makes a new low, who does it attract again? It attracts buyers, right? And the buyers start to come in again, and the moment it goes back to the moving average, those sellers who have not finished selling will start to sell again, and then price comes down again. Okay, so the moving average that basically acts like a magnet. Okay, because that's the safe price for the buyers, for both the buyers and sellers to transact. Okay, so in a downtrend, where do we identify opportunities? Right now, of course, right now this is historical price, but the best price to buy in a downtrend, right, would be B, isn't it? Because that's the lowest, B. Okay, I'm not going to talk about the uptrend one. If you want to know how to respond to the uptrend opportunities, then you look for, just go to SGX Campus on Facebook. Look for the previous webinar where I talk about how do you identify uptrend opportunities, right? Which is this part here. So I'm not going to talk about this part because we already talked about it in the previous webinar. Okay, but what we want to look at is basically this part over here. Where are the opportunities? So if I want to look at the chart, the opportunities will be at B. Everyone agree? Right? That would be the best price to buy. Okay, but the question is, how do I identify B? How do I know that B is already at B? Because when the prices are falling, I do not know where it's B yet, isn't it? Until maybe a few weeks later or few months later, when the price revealed itself, oh, then I know that it's B over here. Okay, only when you see it historically, when you see the past, then you can see it, right? But for example, here, if let's say you see the price are falling to D over here now, how do I know that at this price, the price is possibly at the lowest, and we're going to expect the price to rebound and go up? Okay, so this is where, in technical analysis, we always have this creating the idea first, right? To find opportunities, right? You want where are your opportunities when you look at the historical prices? The second part is, how do you identify these opportunities? Can I use current indicators that are available, all right, to find these opportunities? Like, for example, I want to find opportunities at B, right? Can I use an indicator to identify B? That's the question, right? If I can't find, then of course people will start to create their own indicators to identify B. Okay, and that's the reason why you have so many indicators, because people always try to identify the best possible price. Okay, so the question right now, right? So when prices are falling, what do you do? Do you stay out? All right, because when prices go down, it creates opportunities, and if you miss buying when the prices are falling, you may miss quite good opportunities. And this is what we're going to achieve today, right? But bear in mind that, whatever that is, whatever indicator that we use, also, we do not have 100% certainty, right? They are bound to have mistakes, right? They are bound to have what we call false signals, okay, or wrong signals, okay? But as long as we are able to have more right signals than wrong signals, then we are able to profit from the markets, okay? So in a downtrend, we want to buy at B. Okay, in a downtrend, I do not want to sell above the moving average, because if I'm able to buy at B, okay, if I want to sell above the average, then I may not be able to sell it because the price may not be able to go above the moving average. So here the best price is to basically sell at A in a downtrend. All right. So you buy at B in the sell when the price goes to the moving average. You buy at B when the price when it rebounds to the moving average. At A, you sell again. Okay. Uptrend signal is basically what we have covered in the previous webinar. So like I said, I'm not going to cover this part. We're going to take a look at downtrend opportunities. Okay. So this is an uptrend. Prices go in an uptrend. So we have times when the price, when in an uptrend, when it goes to the moving average acts as support. All right, because this is the safest price to buy and sell in an uptrend. And when the price goes way above the moving average and becomes overbought or relatively high, then that will be probably a better opportunity to sell, or a better price to sell. All right. And again, this is covered on the previous webinar, so I'm not gonna cover this now. What we are looking for right now is this kind of movements, right? When prices are falling into a downtrend, we want to identify B, right? Which is when price is being oversold. Okay, oversold simply means that the price is relatively low. So how do I know how low is low, isn't it? Right? And that's why we want to look at the indicators that's able to give us an indication that it's already low and expect a rebound, right? And here when the price rebounds, remember when the price rebounds to A, like I showed you earlier, when it rebounds to the moving average, that's where we're going to expect resistance, okay, and the price should go down again. So if I'm able to buy at oversold levels in a downtrend and sell at overbought levels, there is short-term opportunities to be made here. Okay. Now this one is of course for those who are interested in short-term trading, right? Because you want to basically short-term trading and investing in long-term. There are two separate strategies, right? Short-term trading wants to take advantage of short-term volatility. That means in the long term, price, if you find a good counter, a good company, and you invest in a long term, generally the price will go up in the long term. All right. But some traders, they want to take advantage of that short-term movements to make more profits, though, to get better returns. All right. So they want to take all these short-term opportunities instead of just buying and holding. Okay. So if you want to trade short-term, then of course the tool that we use mainly would be technical analysis, because you need to know exactly when to get in and when to get out. All right. So how do we identify overbought and oversold? Now you notice one thing, right? That when the price moves way, in this case in the downtrend, right? If the price goes way below the moving average, it tends to rebound. Remember, the moving average is like a magnet, right? The further it moves away, there's a higher chance that the price will rebound back to the moving average. So the question is, right now, how far, okay, should the price go below the moving average before we can see a good rebound? Because sometimes when the price can go just slightly below the moving average and it rebounds, then because the distance is so small from the moving average, you will expect a smaller rebound, right? The moment the price goes way below the moving average, then you expect a bigger rebound. Again, this is also psychologically explainable. Why? Because when the prices go down and people sell, buying and selling in the market has domino effect, right? There's this thing called FOMO, or fear of missing out. When people start to sell, the prices are going down. If the price comes down a little bit, there's no cause of worry. But if the price continues to fall, it affects other people who own the shares, right? To be thinking about, should I still buy, or should I still hold, or should I sell? Okay, but if the price continues to sell, what happens? People start to get panic, right? And everybody starts to sell. And that's the reason why price comes down so steep, right? Sometimes because these people just, they just follow the market, right? They just follow the herd. Okay. When everybody is selling, they just simply sell, sometimes without even, having any rationale at all. Okay, they sell just simply because everyone is selling, right? And when the problem is when everyone sells, the price just suddenly come down. Okay, so the further it moves away from the average, okay, and of course those who are the smarter ones who probably see that, this is just a market noise. When everybody is panic selling, this would be a good opportunity. All right, so Warren Buffett is one of the master of smelling these kind of opportunities. All right, and that's the reason why he's one of the richest men in the world today, purely by investing. All right. So we want to know when the price is being oversold, right? So that's why we use this indicator called the RSI. Now, why RSI? Okay, because there are many other indicators that we can use to identify overbought and oversold. Okay, why RSI? Because RSI has a correlation with the moving average. Now, and this is something that you don't find on books. Okay, because if you are someone who knows how to or love to play with mathematic or statistical formulas, you're actually able to find out the relationship between the moving average and the RSI. All right. Um, so technically, when price is being oversold, it simply means that the price is relatively low. So the word RSI, right, is called relative strength index. Okay, it basically is just let us know or indicate whether the price right now is relatively high. Relative means you have to do a comparison, right? So it compares the historical price. Okay, like here, for example, if you look at this chart, okay, historically, let's say this period of time, you know that these are the high prices. Okay, when the price comes to this high, you know it cannot go higher. That's the highest it went. And when the price comes to this low, it goes to this lowest. Okay, so you look at the historical price as a reference. Okay, so if the price is trading in the green area, that means it's oversold because historically it was oversold. Okay, if the price is trading at this red area over here, then the price is overbought because historically it is at its highest level. All right, or price is relatively quite high. So that's the meaning of overbought and oversold. Okay, so oversold means price is low, overbought means price is high. So sometimes these terms can be quite misleading, right? Oversold means people are selling, overselling. No, it's not. Basically, it simply means that the price is relatively low, all right? And overbought simply means price is relatively high. So this is a formula for RSI, but I'm not going to go through deeply here. But what's the relationship between the RSI and moving average? Okay. So if you look at this part over here, can anyone tell me what's the moving average correlation with the RSI? I'm just going to give you a few seconds to answer if you guys want to try. All right. And if you already attended our basic program, this is already explained lah. Okay. If you already attended our program, we have actually our investing and trading 101 basic program, which only costs 95 ringgit. You can actually just go to our website, equitystriker.com, to check it out. All right, and this is where we explain about investing and also trading, okay, at the basic level to make you understand what it's all about. All right. So for those who know, what's the correlation between these two? Okay. And normally, if I ask this question, nobody want to try to answer, right? Okay, let me just go through with this. Now, if you look at these two lines, right, the moving average, you can see here the price is trading below or above the average, right? In the RSI indicator, so RSI is an oscillator that moves between 0 and 100, right? It moves between 0 and 100 because by calculation, it will never go to 0. By calculation, it will never go to 100 or so, right? So it's between 0 and 100. And then, of course, between 0 and 100, there's this middle line that's 50. All right, that's 50. So what you see over here is that when the price is below this 30-day moving average, okay, if it's below the moving average, you see that the RSI is below 50. All right. When the price is above the moving average, like here onwards, for example, this is where the price go above the moving average, right? And you can see here the RSI also go above 50. And as long as it stays above the moving average, okay, the RSI will also stay above 50. Okay, so basically when price is above the moving average, the RSI is above 50. The price is below the moving average, the RSI is below 50. Okay, and the relationship is this. Okay, the RSI indicator has to be half of the 30-day moving or the moving average that you apply. If you apply 30-day moving average, here you use 15. Okay, I put here 14 because 14 is the default one. Okay, but 14 and 15, there's not much difference lah. But by right, you should use 15. All right. So if you use a 100-day moving average, then you use a 50-day moving average, and then these two correlates. Okay. So again, if you have any questions, you can ask. I'll attempt to answer them, right? Okay, so here I'm using simple moving average. Yeah, so Wendy is asking what's the difference between SMA and EMA. SMA is simple moving average. It means it's just basically a simple way of calculating the average, lah, right? Like you calculate 5 days of moving average, for example, you just add up all the 5 days of data, you divide by 5. Okay, so that's a normal or simple way of calculating the average. There are many other ways to calculate a moving average. So EMA is called exponential moving average. Okay, there's a formula to it. Basically, every data is treated differently, is given different weightage. So if you go and look, I mean, you can just Google like exponential moving average, it tell you the formula, right? Every single data has a weight. The current data has more weight. Okay, for example, today's data has more weight than yesterday's data. Yesterday's data has even more weight than 2 days ago. All right. So when you calculate a weighted average, okay, you actually take the price times the weightage, and then you divide by the total weightage with the price to get the average price. Okay, I'm not going to explain further, but simply, exponential moving average just gives more weight to the current price. It gives more emphasis to the current price. Okay, whereas SMA, it gives same level of importance in every single data point. Okay, EMA gives more emphasis on the current data, and if you apply, for example, 30-day moving average, simple moving average, and 30-day exponential moving average, you find that the exponential moving average, the line, is closer to the price. Why? Because again, it gives more importance to the current prices. Okay, so that's the difference. But here we are working on the simple moving average. All right. So basically, the correlation is this: when price is equal, that means when the price is equal to the moving average, the RSI is at 50. All right. So again, if you use 60 SMA, then you use 30 RSI. And you can see here, right, whenever the price crossed the moving average here, you see that the RSI crossed the 50 level. When the price cross above the moving average, you see that the RSI cross above the 50 level, and so on. Okay, so why do we use RSI? Because remember, RSI is indicator that's able to tell us whether the price is overbought or oversold, right? Our objective is to find that B point, this bottom here. Okay, that means that if the price moves way below the moving average, your RSI indicator will tell you that it's oversold, and that creates an opportunity. All right. So how do we identify downtrend opportunities, right, with both moving average and RSI? These are the steps. Okay, first of all, you use the appropriate moving average. You can always start with 30. If let's say you apply a moving average indicator and you do not know what parameter to put in or how many days of moving average you want to calculate, you can start at 30 first. All right, and then you adjust it accordingly. All right. Remember, you adjust it because you want the moving average to become support or resistance as much as possible. Okay. If 30 is too low, if it cuts the moving average very frequently, if the price cuts the moving average very frequently, then you have to increase the moving average to maybe 40, 50, 60. Okay. If you want to start long term, then you just apply the 90-day moving average first. Okay. Or even 200-day moving average because 200 days is like a yearly average. Okay. So depending on the trend you're trying to identify. But you can, for short-term trend, you can always start with 30. Okay, so let's say you've already identified the moving average, and let's say you put 30 lah, right? So if you use a 30-day moving average, then you use a RSI, which is half the value of the moving average. So if you're using 30-day moving average, then you apply a 15-day RSI. Okay. So how do I identify opportunities? How do I identify B? Right? How when the price goes way below the moving average, that is when the RSI falls below 30. Okay, remember RSI is between 0 and 100, right? If it falls below 30, that means it is near the low. That's why it's called oversold, right? It's near the low. Okay, that's the bottom 30%. If it goes above 70, that means it's at the top 30%, where prices are considered as overbought, right? Or relatively high. Okay. This is just a sample, all right. This is a base sample, but of course, in due time, once you are more experienced using charts and so on, you can always tweak the trading plan to get better returns, all right. But this is to give an idea, right? Remember that if the price falls below the moving average when it's really low, we're going to expect the price to rebound, right? And when the price rebounds to the moving average, remember the moving average now acts like a resistance. So I better sell at the moving average. And again, average price is the safest price to buy and sell for both buyers and sellers. So if I'm able to buy when the prices are very low and it goes to the moving average, then maybe I should consider selling. All right. That means that if the price goes to the moving average, it simply means that the RSI is also now has gone to the middle level. All right. So I wait, right? So if the price goes above the middle level, that means I know that the price is already at the average. But the price can even go higher, isn't it? Okay. So I wait. I do not sell immediately. But as long as the price stays above the middle level, okay, as long as it stays above the middle level, the trend is bullish right now. Because remember, if the RSI is above the middle level, it means that the price is above the moving average, which means that the price is in a bullish trend. So here, if I'm able to buy at the bottom, if the price goes above the moving average or the RSI goes above 50, I'll continue to hold until the trend ends. All right. So that means that if it goes above 50, right, but if it, if let's say the price starts to come down and the RSI pulls back and go back below 50, I may want to sell. Okay, because you have to remember that if the price goes, if the RSI goes below 50, it also means that the price has gone down below the moving average. Okay, from an uptrend, it turns into a downtrend. So I better get out. Okay, but if it continues to stay above the RSI 50 level, then it's still a bullish trend. I will still hold. Okay, or if the price becomes really overbought, that means RSI now has gone to 70. Okay, then I'll probably want to sell as well, because in trading I do not want to be too greedy, right? Because when the RSI goes above 70, it simply means that in an uptrend, right, it is also overbought. Okay, in a downtrend, if the RSI goes to 50, it is overbought in a downtrend. Okay, but if the RSI goes above 70, it means that the price is overbought in an uptrend. Okay, so you're probably going to see a peak in prices. Okay, so that's why you can either sell at 50 or wait for a price, or the RSI to go above 70, then only you sell. Okay, so in a downtrend, this is what we want, right? We want to identify B over here. Okay, where number one, the price is below the moving average, because we are trying to identify what to do when the price goes into a downtrend, right? In a downtrend, I do not want to buy when the price is falling, but the moment the price goes to oversold, which means that the RSI is below 30, then I get ready. Okay. And if the price goes to 50 back again, if it rebounds back to 50, I may want to sell. But if it breaks above 50 and and it stays above 50, I will continue to hold, okay, until the price goes below 50 again, or the RSI goes above 70. Okay. So let's take a look at an example. Okay. Again, this is an uptrend. Again, an uptrend is, we use different methods to identify opportunities to buy in an uptrend. But here you can see that in 2020 February, for this particular counter, this is UMS Holdings in Singapore, right? And the good thing about technical analysis is that you can apply this not just in one market, right? You can apply this in any other markets, including the Malaysian market, including the US markets, and so on. Okay, because the behavior of price is same in any markets. Okay, so like here, for example, when the moving average starts to go down and the price is trading below the moving average, it becomes a downtrend, right? But the question is, as the price starts to fall, when should I consider getting in, right? So when the price falls, remember, it has to move way below the moving average before we can see a significant rebound. Okay, so how do I know it is way below the moving average? That is when RSI goes below 30. Okay, so only when the price comes down to these levels, then I would consider. Okay, so if I'm able to buy when the prices at these levels. Okay, the moment it goes up, okay, let's say you are able to buy here and it goes up and it comes back to the moving average. Remember, when it goes to the moving average, we expect resistance, right? But because it breaks above the middle level and it goes above the moving average, and here it continues to stay above the moving average. So the good thing is, if the price is in an uptrend and it's trading above the moving average, you don't sell, right? You just hold on until the trend ends or until it becomes overbought in the long term. Okay, like in this case over here, as the price starts to increase further, it becomes an uptrend right now, right? Because RSI is above 50 and the price is trading above the moving average. But the moment the RSI over here goes above 70, it means that the price is also overbought in the long term. And this is where I do not want to be greedy. I'm able to take, I should take profits over here. Okay, so in this short period of time of about 2 months, the price rose from about 40 cents over here to 60 cents. That gives you about 40 to 50% returns, okay, in just a matter of a short period of time. Okay. If you look at this example, again, this is where the whipsaw is. And you can see in a whipsaw, the RSI is being cut quite frequently as well. And the RSI does not fall below 30 or go above 70. So that means you know that this is an uptrend. Okay. What we want here, now that the price is falling, right? It's falling. It went below the moving average over here. It continues to fall. All right. It continues to fall. But I will only look at this counter as the price falls when the RSI goes below 30. Like in this case over here, only one day the price fell to 30, and this creates a window of opportunity over here, right? So if I'm able to buy here, then I will only sell when the price starts to go, the price starts to go above the moving average or the RSI goes above 50, right? Like in this case over here, the price goes above the moving average, it continues to go up. And you can see the RSI also goes above the 50 level at the same time when the price goes above the moving average. As long as it stays above the moving average, I hold. But notice here that the price starts to go down. Okay, and the moment the price goes below the moving average, or the RSI goes below 50, I will exit over here. Okay. Now, same thing here, right? So down again in the downtrend, but the price has gone way below the moving average until the RSI say that it's oversold. Then this creates an opportunity to buy. And then as the price rebounds to 50, I'm able to sell. Okay, so like in this case here, if you look at the current price, because remember I told you that you only make decision at the current point, right? So if you look at the current price, you know that the price, number one, is in an uptrend. Number two, it is overbought. Okay, so if I'm going to buy here, this will be at the highest risk because I'll be buying at the highest price. Okay, the best I can do is for the price to pull back, right, at least to the moving average. Then I get ready to buy over here in the pullback. Okay, and again, this uptrend opportunities is covered on the previous webinar. So do check out the recording on SGX Campus for the previous webinar where we look at identifying uptrend opportunities. Okay, so what we are focusing now is the downtrend one. So same example here, right? This uptrend, the price is above the moving average. And the moment the price goes below the moving average, okay, in fact, all these examples here is based on a 30-day moving average. Okay, 30-day basically is short term, right? So same thing when the RSI falls below 30, okay, that's where my opportunity is. And when the price or when the price goes to the moving average or the RSI goes to 50 and starts to pull back below 50, this will be my selling opportunity. All right. I think this one is a little bit out of alignment. Okay, this one's supposed to be here, and this one's supposed to be here. This period here is when the prices are over. This period here is when the price is oversold, and this is when it's overbought. Right, when it goes above 70. Yeah. So this is better looking. Okay, so when the price falls here, you get ready to buy. This is where you can actually buy, and when the price rebounds to 50, when the RSI goes to 50, you're supposed to sell. But because the price continues to stay above the moving average, you just hold on, right? You can just hold on until the RSI goes above 70, which means that the uptrend is also being overbought. Again, I do not want to be greedy. I will take some profits over here. All right. So this is very simple, right? just by looking at overbought and oversold, but you need to use it together with the moving average lah. Then you give you a better picture. Okay, so the question right now is, how do I identify opportunities, right, when prices are in a downtrend? Okay, but before I go there, are there any questions before I continue? Okay, you can post the questions if you want to, because I'm going to basically right now share the website, right? It's sgx.equitystracker.com. Okay, so here you can see we have the strategies selector for stocks, and you also have REITs analyzer, which is coming soon. All right, right now you don't have, you click that, there's nothing there yet, but this is coming very soon. Okay, you have very in-depth analysis on the REITs market in Singapore. All right, and nobody's providing this at the moment. Okay, so when you go to sgx.equitystracker.com, you have the strategy selector. You just have to click select stock selector or strategy selector. You can see here, right? There are six selectors. Okay, tradable stocks. These are all self-explanatory. Basically, tradable stocks are stock that has good liquidity and volatility. So, like here, for example, here you can scroll. There are quite a number of stocks here that meet two criteria. Okay, if you want to trade a stock, number one, you need to find stock that has volume to trade, right? Consistent volume, not just today volume, but volume consistently. And number two, for trading, you need volatility. So tradable stocks are basically stocks that has both good liquidity and volatility, right? Rock bottoms are basically stocks that has fallen 30%, at least 30% from its 3-year high, right? So we have the historical high, and all these counters has pulled back more than 30%. Right, so when you click on this, you can see, like here, for example, Singapore O&G Limited has fallen 63.7% from the historical high. Okay, so if you look for rock bottoms, that means prices are really low, at really low prices, then you look for rock bottoms. But you have to remember that you can't use this as a way to identify is a good opportunity to buy, because here is where you need to use other tools, like, you know, you look at the fundamentals of the company. If the financials are not doing good, right, it has been very bad for a period of time, then of course this particular counter deserves to be at the bottom lah. Okay, but there are times when we have really good companies, but because of market sentiment, because of emotions, the price can be at a discount. All right, so this rock bottoms here is basically good in conjunction with fundamental analysis. So you look for this particular stock, and this particular stock is low in price but has really good fundamentals. That's where you want to look for opportunities. All right. So uptrend support opportunities. This is what we covered last month, right, in the previous webinar. This one here is where this is the tool that we're going to use to apply what we've learned today. Okay, downtrend oversold opportunities. Oversold means price is low. Downtrend means price is in a downtrend. All right. The other two is basically overbought. That means when prices are high, we call it alert, because when it's high, watch it very closely, because you may want to take profits. Okay, so you apply for today's lesson, we apply the fourth one over here, right? The one on the left at the bottom, downtrend oversold opportunities. That means price has gone to B, right? Oversold, remember, RSI is below 30 and the price is below the moving average. Okay, so when I click this is where you find ideas lah, right? When I click this, you have the short-term one based on the 30-day moving average. We also have basically three moving averages over here. We have the 30-day moving average, we have the 90-day moving average, and the 200-day moving average. So short, medium, and long term. Okay, so we have short term here, 30-day moving average. We have medium term. This is based on 90-day moving average with a 45-day RSI. Then we have long term, 200-day moving average with a 100-day RSI. Right, so you can see here that the medium term and long term, you don't have any counter that falls to its oversold level. So we only have one, okay, and this is Sheng Siong Group, short-term 30-day moving average. Okay, so if I click on this particular counter, I will go to the charts, right? And you can see that price is in a downtrend. All right. So this is based on the 30-day moving average. So I'm going to put in I'm just going to show you the 30-day moving average. This is the 30-day moving average. And prices are basically in a downtrend, and the price is oversold. All right. So you can see over here, right? And this is where you need to make your judgment, right? Because if you're going to buy, let's say like currently at 143, right? And you know that the moving average here is 147, all right? Current price is 143 and it's already oversold, right? But if it goes back to the moving average, it will become overbought. And that's only 4 cents from the current price. So question is, do you want to take that, do you want to trade this particular stock for potentially only 4 cents opportunity? Because you can see here, whenever the price goes to the moving average, okay, it pulls back down again. Okay, same thing here as well. On the 11th of October, the price goes to the moving average, it comes down back again. So if I want to sell, if I'm going to buy at 143, for example, I will not even want to dare to sell at 150 or 160 because this is way above the average. Okay, the best price or the safest price to sell if I would to buy this particular counter will be near the average, and that's 147. Okay, so 143 to 147 is only 4 cents. So, I mean, if you calculate 4 cents and you minus your commission, minus your risk, you might as well just forget about it, right? Because there's not much opportunity. Okay, but if let's say the difference is 10% from the current price to the moving average, or 15% or 20%, then that create a better opportunity. Okay, so the good thing about this particular list is, if you want to look for ideas, you want to find stocks that has gone below the 30 level, or the RSI goes below 30, this will be a good tool to use. And once again, this is available for free. All right. Although this price is in that particular list, all right, but it's just that because the opportunity is too small, I may just want to forego and just wait. Okay. The good thing is this list is updated on a daily basis, every single day. All right, you can see here this is updated up to 26th of October. This is today. Okay, tomorrow end of day. This is updated on at the end of the day, right? So you'll see this updated every day. Okay, so as long as Sheng Siang stays or the RSI for Sheng Siang stays below 30, you'll still see this stock here. But the moment it goes above 30, you will not see this stock anymore. Okay, because it does not fit the criteria. So tomorrow we may have another counter, or maybe not even one counter. So you can monitor this on a daily basis, okay, and apply what I've actually teach you today. Okay, so that will be downtrend support, oversold opportunities. Okay, to apply what we learned today. Okay, so just head on to sjexequitystriker.com. Yeah. Okay, let me see your questions right now. Chua is asking your second green rectangular first RSI also, if you enter that point, we lose, right? How to prevent that? Yeah, okay, very good question, right? Remember, I told you it's called opportunities because when the price falls to below 30, you may not want to enter immediately, right? Now, this is where you need to look for reversals. How do I identify reversals? One of the indicators that you can use to identify reversal. Let me get back to the chart to give you an example, right? Let me get to a chart. Okay, here, for example, this one is a good example. Like you see here, the moment the RSI goes below 30, the price is just here, right? Let me put in the laser pointer. RSI has already gone below 30. This is already, at this price, is already considered oversold. So if I'm going to buy the moment the price goes below 30, notice here the price actually go even lower. Okay, I think this is your question, right, Chua? Because the moment the price goes, and if I buy here, it goes lower, what do I do? Okay, of course, you need to have a proper trading plan. Like, for example, if I were to buy at this price, where do I put my stop loss? All right, that's one way. The other way is, of course, you can also apply candlesticks, right? Candlesticks is one way to identify that the price is reversing. So the price is going down, 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 down. I will not buy. Although RSI has gone below 30, I will not immediately buy until I see there's an indication that the price is reversing. Okay, so you can use candlesticks together to again improve your trading signals, all right? Or you can use stochastic indicator and wait for the stochastic to cross above the midline and whatsoever. Okay, so you can apply other tools to prevent you from buying a little bit too early. All right, because what we want is a confirmation that the price is reversing right now. Okay. Joel is asking, do you use this together with Ichimoku and all? No, this one you just have to use, because moving average is also a trend indicator. The Ichimoku is also another trend indicator. There's no point using so many of them, right? So because this two is correlated, we use them together. All right. So we don't need to use Ichimoku, because if we use Ichimoku over here, then it becomes redundant. Okay, the moving average is already there. Yeah, so Wilfred, I think your question is about the same with Chua. The RSI can remain at 30 for a period of time, right? So how do you, again, you don't immediately enter, okay? And if you go to sjax.equitystracker.com, you remember there's a tool there called tradable stocks, right? One of the biggest problem for most traders is you can look at indicators, right? You can have a trading plan, you know when to enter, when to exit, but if you apply it on a wrong stock, you get wrong results as well, different results. Okay, and that's the reason why we have that tradable stock list over there. Because remember, tradable stock list has good volume, it also has good volatility, right? So you try to prevent stock that, like you said, Wilfred, right? We want to prevent stock that doesn't move one. It goes 30 and then just stay down there for so long time. It just continue to stay and the price goes down. So we want to prevent that. Then if you really want to trade for short-term movements, then you look for stocks that are in the tradable stock list, because these are stocks that meet the two important criteria for trading, okay, which is good volume, right, and also good volatility. Okay, so that's one way. Okay, of course, the other way is you can use other indicators to confirm your entries better lah. Okay. Okay, you can just keep on asking the questions. We're almost coming to an end. Now, one of the things you can do is, if you're already on SJAX campus Facebook group, we actually have this thing called Learn and Earn contest. We have every month we have 2 quizzes for you to win 100 ringgit worth of touch and go top-ups. In fact, we just had the first one last week, and we have already identified 3 winners, and this winners list will be up probably end of this week, because the winner will be only announced 1 week after the contest or after the quiz. All you need to do is to answer 5 questions correctly. And if you get it 5 right, the first 3 who answer it right will win the 100 ringgit each. All right, touch and go. So there's no registration required. All you need to do is to join SJX Campus, all right, Facebook group. Okay, if you already join, then you're already one step of getting into the contest, right? You just have to join, okay? And if you look at the post there are the terms and conditions over there. And then the second thing that you need to do is to join the SJX Invest Telegram. Okay, the reason why you want to join this is because this is where you get information, right, on investing in Singapore stock market. That's why we call it Learn and Earn. So you learn about Singapore stock market. You can also stand a chance to earn money, okay, which is the touch and go top up. So this is just what you need to do. Join the SJX campus, right? And also join the SJX Invest, because SJX Invest is actually run by the SJX himself. This is where you get the updates on the Singapore market. Okay, so it's both of these are learning tools. Okay, and the third learning tool is, of course, the sjx.equitystracker.com. Okay, so for more information, our colleague will put the link over here. You just need to go to Facebook, facebook.com, search for SJX Campus, and just join the group. All right, you may be the next 100 ringgit touch and go top up winner. Okay, any more questions? Okay, if you came in late, or if you wanna look at this video presentation again, this webinar will be recorded. It's on SJX Campus, so you can view the video again when it's when it's available. The recording is available again lah. All right. All right. So if no questions, I hope today's session is beneficial for you guys. And once again, thank you for joining us tonight. I hope that this lesson, can propel you from finding opportunities in the SJX market Okay, just apply the tools. Even if you don't put with real money, just try it out first, and hopefully that you're able to use this and profit from the markets. So thank you very much for joining us once again, and we'll see you again.